Hello and welcome to a fresh new edition of Bazaar Morning Call. I am Prashant. With me are my colleagues Sonia and Nigel. It's the most auspicious time of the year, guys. And, I just hope that with our changed attires, with our changed location, we're able to reflect some of that here over the next 2.5 hours. Good morning.
Good morning, Prashant. Good morning, Nigel. And to all our viewers, there's Diwali coming up, there's Dhanteras over the weekend. It's a long weekend, so here's wishing all our viewers a very, very happy Diwali. And it's befitting, right, to work from our newsroom today, the place where we spend the most amount of time through the year. So, yeah, happy days.
Well, that's right. Wishing all our viewers, the very, very happy Diwali ahead of that. And in fact, the festivities as well. You guys actually are joining me because on closing bell, almost every day I sit here. So I think I'm a pro in this.
Nigel is the location pro here, so he's going to tell us the ins and outs. Let's just kick this off in terms of how things are set up. Thankfully, it's quiet, right? I mean, you want a quiet wrap out to the week because last 2 weeks or so, it's been absolutely crazy. Just a couple of points to set things up. I think the big driver for markets still remains what's happening on U.S. yields. So the U.S. Terminal rate, right, what is called the terminal rate, where the Fed rate will peak out, that made history last night. Market pricing of the Fed's terminal rate is now above 5%. I mean, that is absolutely astounding. The silver lining for us is that the main channel through which most damage gets done in emerging markets when yields in the U.S. spike is the dollar. And the dollar is relatively well behaved. The big spike in yields is not showing up in the US dollar. And we've got good earnings. I mean, I think that is a big support here. Axis Bank has reported absolutely blowout quarter. Canada, yesterday. So financials and banks still remains, I think, the best hunting ground if you're looking for opportunities. Sonia.
So, when you say quiet, right, that most of the market is on leave. I mean, there's a long weekend coming up and Monday is a holiday, Sonia, Wednesday is a holiday. That's what quiet means. We're the only ones working here.
I would like to believe that, the audiences are watching us in rapt attention. I mean, all of them. No? Yeah.
I think except maybe my mother and Nigel's mother, no one else is watching us today. Okay, but the big cue for me this morning definitely are the blowout numbers that came through from both Axis Bank as well as ITC. And I think the market is going to take that with both hands, and that's the festive cheer that we're getting into this morning. Stellar quarter from Axis Bank, a loan growth of over 17% year-on-year, margins at a 26-quarter high, and a lot of brokerages have upgraded their target prices, earnings estimates, JP Morgan case in point. ITC as well, super performance, no complaints at all. Cigarette business delivered a 23% revenue growth, and even other companies, like Bajaj Finance, for example, decent growth coming in there. That's the one positive surprise. The other positive surprise, according to me, is that FIIs have now bought in cash after 9 days of selling. So they bought about 1,864 crores in cash overnight, and DII sold about 886 crores. And of course, the global market cues are not that great. The Dow is down a bit overnight, but give and take everything, we do know that there is this stark outperformance that India has seen between last Samvat and now. And even, yesterday as well, the Nifty held on to that 17,500 mark. So despite all the challenges, key levels are being protected.
Sorry, same time yesterday, it was looking a lot more tricky, right? With the same kind of cues from overnight. So similar 1% kind of cut on the US market the previous day, but yesterday the SGX was down a lot more. And I was saying this yesterday that maybe the dynamic of outperformance comes back, relative outperformance, and that is essentially what played out. Let me just quickly outline, and I think the trouble is global, nothing else. So yields in the US are basically breaking out into new highs. The 2-year, which is the most sensitive to what the Fed is likely to do, that is topped 4.6%. It continues to make new cycle highs. The 2-year, the 5-year and the 10-year were up 9 basis points and 10 basis points respectively. And as I said, the market pricing of what the Fed will kind of do in this particular cycle is now moved up to 5%. So, I mean, if you believe market pricing, there is a lot more to go. Also, it did not help that you had Fed officials saying that, well, we will stop hiking only sometime next year. Then we will keep rates high. And then after taking into account how it is fed through into the economy, we will decide what to do and maybe hike more. This was the Philadelphia Fed president. It kind of added to the pressure. The market, by the way, held up nicely. It only sold off the US market in the second half of trade. The silver lining, as I mentioned earlier, is that it's not showing up in the dollar. I mean, higher dollar and, of course, higher crude prices are the two main channels through which all of this impacts emerging markets like India and other emerging markets generally. the dollar index faced resistance. I mean, it did recover from the lows, but it's holding at the 113 kind of level. It did not see a very large move. I mean, I'm talking about commensurate move to what we saw in the yields market. So the way I would put it is, even in the US, right, we've bounced off the S&P from 3,500. There is no clear directionality. Maybe, and I think this is a question which will be answered in the coming days, the very small mini bear market rally in the US is already behind us. We'll only be wiser in hindsight, but it's gotten a little more cloudy, a little more foggy, but no real clear directionality. I mean, you can't say that, well, things are headed south once again. Maybe it kind of meanders here for a bit more. We've got the monthly US options expiry later today, and I think that is always an important event to watch. You usually see, not usually, but more often than not, see large pronounced moves there. Coming to the Nifty, and I think I would go with what I said yesterday, a relative outperformance, I think. I mean, that's basically going to be the dynamic which very much reasserts itself. The market, by the way, bounced very nicely from the day's low, but it closed just under 17,581. This is nothing but the 61.8% retracement of the fall from the 15th of September high to the 30th of September high. If this is crossed, the next level is 17,700. That is basically the level on the upper end of the rising channel from the 30th of September low. So again, these levels are not very far away. A good day and these will get taken out. On the way down, I mean, I think the big supports are the 40 exponential day moving average and the 20-day moving average, which are 17,300 and 17,200. And on the Bank Nifty, which I think is the clearer of the two between the Nifty and the Bank Nifty and the banks, 39,850 is the support. 39,850 is the support on the Bank Nifty, which, by the way, I think was the low for yesterday as well. We almost got to those levels. And yesterday, there was a bit of a clear differentiation. The Bank Nifty was down, but the PSU Bank space rallied on. The PSU Bank index was is up 9% with 1 day to go this week. So I think, I mean, that's been quite a decent move that we've had. So I think, I mean, the dynamic broadly is relative outperformance, which very much is at play. Nigel, what are you watching?
Well, you know, for me, two factors played out yesterday. One is the stability in the rupee. The rupee pulled back, and that coincided with the Nifty as well recovering. And the second factor was it was weekly expiry. So those call writers, they got stuck on the wrong side. So there was a bit of covering that we saw. So both those two factors did play out. Now, the dollar index, as you said, it's looking a little bit stable at around 113. It tried to move yesterday higher, but I think midnight, again, it went to around 112.5, 112.3 odd, which is good news from an emerging market perspective. You don't want it to run away to around that 114.5 that we saw earlier, but that's one of the key monitorables. The Nifty Bank yesterday took a bit of a break, but the IT index, that came to the party. And if you're looking at it, you know, in the last 1 month or so, the IT index gradually has been moving higher. In fact, it's up closer to around 7%, while the Nifty is up only around 1%. That's telling you the kind of outperformance you've seen from the IT index. Now, the Nifty IT index now is only around 8 to 9% away from its 52-week high. I recall when it was 25% away. So it's seen a good recovery from the lows. Getting past the 70,650, that's going to be very important. We have big triggers. Reliance Industries comes out with its numbers. You have ITC reacting to its numbers. And big banking names as well will be reacting. So the ingredients are in place if you can go ahead and take out those higher levels. What did the FIs do yesterday? They were back to their shorting ways. They added shorts, more than 20,000 short contracts. And now the short positioning is at around 72%. And since we have expiry next week, it appears there's a bit of a short straddle at play. What is that? The 17,500 call as well as put. They are getting written, pocketing close to around 280 to around 300 rupees and bracing for a bigger move. You know, 17,200 to around 17,800. So the goalposts for this expiry, at least, they are set at both these two levels. On the downside, you have a feeling that, you know, that base has moved up to around that 17,300, 17,350, at least in the near term. And if we can conquer that 17,700 mark, then the bulls will like another dash towards that 18,000 odd mark. But the most important cue for me is, again, the stability in the rupee. You don't want to see that one running away. Yesterday, it pulled back a little bit, and you would like it to hover around these levels or maybe strengthen a little bit, which will be difficult because the dollar index is holding like a rock. SGX Nifty earlier today was indicating a bit of a red start. Looks like it's participating, I think, in the festivities. It's moved into the green and now indicating some green. We'll start off close at around 17,600, which is good news, Sonia.
SGX must be thinking, you know, these guys are all dressed up. Right?
So let's not disappoint them.
Let's kickstart the party, right? And I mean, you were talking about all the cues to watch out for. I was just thinking it's time to go for Diwali shopping, and then I remember there's Reliance's numbers in the evening.
You're going to be late.
So, a long day.
A true story, by the way, and this is day before yesterday, and we decided to, me and my wife, we decided to pick up something. It was a birthday yesterday. We decided, she met me here and we said, we'll go to Phoenix, which is next door, right? but you had to do a bit of a loopy-loop to get into the Phoenix Mall, right? We drove all the way around, and then we did not go. We went back home. Traffic, Sonia. I mean, shopping online is great, but...
I was just going to say that, you can buy digital gold nowadays. You don't need to go to the physical store and buy gold if that's what you're looking to. Just giving you some ideas for Diwali and Dhanteras this time. But you know what, folks? There's so much to talk about in the next 2.5 hours. It's festive season, and we have plenty of opinion coming through for you. So without wasting any time, first up on the equities front, we have a comment coming in from Neelkant Mishra of Credit Suisse, who says that over the past 3 months, cuts to India's FY24 EPS have been relatively moderate. He adds that 40% of the GDP gap versus the pre-pandemic trend is due to goods retail wholesale, but we and CSO lack good high-frequency measures, keeping us cautious on discretionary, but better overall growth should help banks and the cement sector.
All right, Surendra Goyal of Citi believes that equities will be relatively resilient in a volatile global world. He says that Citi's FY24 EPS sensitivity analysis to the scenarios indicates 5% upside in soft landing scenario and a 9% downside in a hard landing scenario. Their base case for December 2023 Nifty target is 17,700. They're overweight financials, autos, PSU utilities, and underweight staples, metals, and IT services.
Okay, let's also get you some money market views, right? They assume more importance nowadays with the way the rupee has been shaping up. So we have a comment coming in from Bhaskar Panda of HDFC Bank, and here's his view. He says that inflation concerns in uncertain times remain the biggest underlying theme for all central banks. He says the US Fed speakers unrelentingly are bringing this point, and as a result, yields are remaining up. He adds that Japan's CPI has come out higher, testing Bank of Japan's policy divergence. He also talks about how oil remains as a big hurdle for the market. And in India, he says the dollar-INR pair traded in a very choppy range yesterday as the pair played to the demand-supply dynamics in an illiquid market. He also says we could see a bit of consolidation, and the dollar-INR pair could trade in a range between 82.80 and 83.10 for the day.
Well, on the bonds, we've got Bhaskar Panda saying that Indian bond yields have risen following higher oil prices and higher bond yields in the US. He expects the 10-year benchmark bond yield to trade in a range of between 7.45 to 7.5% for the day.
All right, let's tell you about the stock-specific action. Then we'll get to that in just a bit in our special Top 10 segment. Well, we're looking at Axis Bank, ITC, Bajaj Finance, Tata Consumer, Sriram Transport, Happiest Minds, as well as Dixon Tech. Well, they are stocks that are on our radar on the back of positive news flow. While we have United Breweries, Emphasis, as well as IEX, they are stocks that are likely to open up in the red.
All right, we've got Abhilash Narayan now joining us, Senior Investment Strategist, Group Wealth Management at Standard Chartered Bank. Abhilash, great to have you back on the program. Thank you very much for your time. So, yields in the US are moving higher, maybe expectedly. But the question is the rally that we've seen in the US, right? It was just developing into a meaningful bear market rally. Is that already behind us? I mean, have we seen the best of it with what we've seen last 2 sessions in the US? Your sense?
Well, I mean, what you're seeing in US is clearly a tug of war, right? So if you look at the earnings that are coming through in US Q3 earnings season, they have been better than expected. So of the companies that have reported so far, 74% have beaten expectations. So that's obviously been a key positive driver for US equities. But on the other hand, you do get the downward pull from rising bond yields. And if you look at what's happened in the past week or so, you've seen the expectation for the peak or terminal Fed fund rate rise to around 5%. And just about a month back, that was around 4.5%. So we have seen markets pricing in more hawkish policy from the Fed. And that's been one of the key reasons, along with the guidance from Fed speakers, for 10-year Treasury yields moving higher. And higher yields are going to be sort of a headwind towards any upward move in equity markets. So, it's something that we'll have to watch out for. But we don't think that there's much wind in the sails for US equity bear market rally just as yet.
Okay, Abhilash, good morning and happy Diwali to you, by the way, in advance. It's a crackling Diwali out here in Mumbai, at least, after many years, celebrating in full throttle. So, greetings of the season to you. Do you think this is the time to be fully invested in India? And if not, perhaps put some more money to work as well because of the kind of outperformance that we're seeing?
Well, happy Diwali to you and all the viewers as well. I think it's an interesting question, right? So when we think about Indian markets, Obviously, Indian equities have outperformed global equities on a relative basis, and that's a call that's worked well for us since March this year. But given the outperformance that we've seen in Indian equities, the relative PE ratios or relative valuation of Indian equities compared to global equities and even emerging market equities are starting to look quite expensive. So what we have done in the past month or so is that we've now turned neutral on equities versus bonds, because we think that RBI will hike rates till around 6.5%. So 10-year yields could move to around 7.5 to 7.75% range. But we think that if investors want to put more cash to work, then rebalancing or allocating a bit more towards bonds is looking a lot more attractive to us at the moment.
Hi, Abhilash. Morning. Abhilash, since the Indian markets are trading fairly expensive, what could help us is if earnings growth don't disappoint. And that seems that the street is, has a bit of a problem with FY24 earnings, because this year we could get through. What's your sense on it? What kind of earnings growth will you be happy with from the Indian markets for FY24 in particular?
Well, if I look at next 12 months, so not exactly FY24, but a similar time frame, we expect earnings growth to still remain in double digits, around 13-14%. So it's still healthy on a relative basis, but obviously it's not as good as what we've seen in the past couple of years. So as you rightly pointed out, earnings growth becomes very, very important going forward, given the valuations. But we do have fair degree of confidence that Indian equities should be able to deliver higher earnings growth compared to global equities. And sectors that we specifically like include the banking sector, infrastructure, as well as consumer staples.
Abhilash, the other bit is what's happening in the UK, right? But this is not a question really about what this means for the UK, but all of the flip-flop. What does it mean for markets broadly? To kind of sharpen that question a bit, especially from a bond market perspective, what's your sense?
Well, yes, we've seen a lot happening in the UK, and we just saw PM Liz Truss resign. Now, if I look at it from a broader market perspective, what it means is that there is going to be a greater degree of uncertainty, because the UK needs to elect a new prime minister, and we do have the key fiscal plan announcement scheduled for 31st October. So if you're looking at the broader risk sentiment, if we do see a disappointment there, markets could have a knee-jerk reaction, and we could see a bit of a risk-off move in UK assets especially, but also for global assets. But see, from a broader picture perspective, it doesn't really matter as much for Asian equities or Asian assets in general, because Asian assets are driven by their own earnings growth and economic growth outlook. I think from a currency perspective, we think that the pound looks a bit overstretched. So pound is close to the levels that it was at when previous Finance Minister Kwarteng had announced the mini budget, which led to a sell-off in UK's assets. So we think that the pound does not reflect the downside risks to UK economy. So we expect it to come down to around 1.10 in the coming few weeks. But yeah, I think from a global market perspective, US or India, it shouldn't matter much beyond the knee-jerk sort of impact.
All right, Abhilash, it's a pleasure. Thank you very much for joining us. It's been great speaking with you. As always, happy Diwali from all of us here, to you, to your team, to your family as well. Guys, do you remember any event in recent memory which has generated the amount of memes that what has happened in the UK has generated, right? I mean, it's just a street. I mean, I almost feel sad for the outgoing Prime Minister. She's been the butt of jokes and how.
And especially, do you think she's lost the trust that she had in people? Well, it's the last trading session of this Samvat, and what a year it's been, battled so much. Global, local, and here we are with the Nifty at that 17,500 level. So let's talk about individual stocks and things that you need to watch out for. Axis Bank had a cracker set of numbers. Abhishek is here to give us a quick review. Abhishek, over to you.
Well, Sonia, to begin with, is firing on all cylinders for Axis Bank. To begin with, net interest margin is at 26-quarter high of about 3.96%. The gross NPA ratio X of RBI dispensation quarter is perhaps the best in last 26 quarters, and net NPA ratio is perhaps the best in last 28 quarters. So best return ratios in 7 years that you are seeing for Axis Bank, with ROA of about 1.8% and an ROE of about 18.5%. CASA ratio, or the low-cost deposit ratio, at 46%. 6.2% is the best that you are seeing in last 16 quarters of 4 years. On the weaker side, the deposit momentum has slowed down to about 10.1% on a YY basis, which is the weakest in last 6 quarters, but no taking away from the fact that it's a huge beat on PAT versus our poll. They have come in at 5,330 crore. We are working with a number of close to 4,344 crores. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, Mangalam, coming across to you, probably the stock of the day, ITC. The street was sensing it, but those numbers, smoking hot, I'm guessing.
Smoking hot stock of the day, and has been the stock of the year so far as well. 57% jump on that. You guys were talking about memes on Liz Truss, etc. Don't forget the memes that ITC's underperformance had on the last trade as well, and it's the believers who are laughing all the way to the bank, because the stock has the results have fired on all cylinders, and it is led by the cigarette business itself. Revenues at 16,100 crores, largely in line with expectations, but it's the operational performance and the net profit which has beat expectations by a mile as well. The cigarette business out there, the revenues grew 23%. The street was working with a number just around 16 to 18%, and that's led from the front. And add to that, FMCG revenues also grew 21% as against expectations of 10 to 12%. All the other verticals of the company, hotels, agri and paper, did extremely well. Some beat parameters or some met just the lower end of the expectations. Cigarette volume growth of 20%, FMCG margins being stable year on year and growing quarter on quarter despite inflation is something that the street should like. And despite the rally, the stock is still trading at 21 times, so it's at a discount to the sector. Continue to see some bullishness on ITC.
All right, Mangalam, thank you very much for that. We'll watch out for the stock reaction. But Bajaj Finance is the other one which reported earnings. Abhishek is here with details. Abhishek.
Well, it's a good set of numbers coming in for Bajaj Finance, Prashant. AUM growth on a YOY basis at about 30.8% is perhaps the best that you are seeing in last 11 quarters. The gross NPA has come down a bit to 1.17% when compared to 1.25% in the previous quarter. The NII growth has been pretty good, about 31.2% YOY and about 5.5% quarter on quarter. Calculation shows that there might be a 20 basis point decline in the net interest margin on a sequential basis, but no taking away from the fact that, robust growth in PAT is seen about 88% YOY and more than 7% sequentially. The return ratios are strong with ROA at 5.4% and ROE at 23.6%. Back to you.
Okay, thanks a lot for that. So that's a decent set of numbers coming through from most of the large players. Let's find out how Tata Consumer did this time around. Mangalam, over to you.
Well, it was a largely in-line set of numbers coming in from Tata Consumer as well this time around. There were pockets of strength in their non-T, non-UK business, and that is something that would support the stock. But the macro, concerns with regards to what's taking place in the UK and international markets may stop the stock from seeing a runaway rally. The net profit at 355 crores versus expectations of 270 crores was led largely by an exceptional gain of 111 crores, which the company made on sale of land. In India, branded revenue grew by around 9% in line with expectations. Packaged beverages actually declined by 7% versus a 5% expectation of a decline. And foods business grew 29% versus expectations of around 20 to 25% growth. So the India pack is doing well, led by Salt, Sampann and Soulful. But at the same time, UK, the revenues declined by 7%. And we did see a lot of margin erosion, primarily on account of depreciation of the British pound. And that is something that we'll have to navigate with.
All right. Okay, Mangalam got that on Tata Consumer, but let's get to a little bit more interesting company. That's United Breweries. I think the beers will be in focus in the next few days, but should be the past quarter wasn't that great?
The results for United Breweries were kind of a mixed bag. The revenue that came in below our poll at 1680 crores, but EBITDA was above our estimates. The EBITDA margin came in at 13%. Gross margin saw a contraction of nearly 5%, but that was expected due to the inflationary pressure. They reported a volume growth of 23%, and almost 50% of this volume growth came from the premium segment. So looks like premiumization trend is going to continue. Now, what doesn't work for this stock is that the realization per case was down 4% on a year-on-year basis. Additionally, the management said that they expect the inflationary pressure to continue, and they're in the process of taking further price hikes in the second half. So we will go with a red on this one.
Okay, premiumization, we talk about that. A growth of 48% is what United Breweries has seen. An apt stock as we head into the long weekend and Diwali festivities. But let's go across to Abhishek. He's also tracking Sriram Transport this morning. Abhishek, how is it looking?
Well, Sonia, CV sector has done well in Q2, and it's a superb quarter from Sriram Transport, the highest ever quarterly disbursements coming in at close to 17,800 crores, up about close to 20% YOY and about 6.6% sequentially. The AUM growth on a YOY basis is the best in last 15 quarters, and sequential growth is the best in last 17 quarters. The net interest margin is at 11-quarter high, close to about 7%, which has driven the return ratios as well, who are the best in last 11 quarters, with ROA at 2.66% and ROE at 15.6%. Both in terms of NI and PAT, they have beaten our poll. Back to you.
Okay, all right. Abhishek, thanks a lot for that. But let's talk about a couple of mid-cap IT companies. Rima, Emphasis as well as Happiest Minds, but expecting them to go in different directions?
Yes, so let me start with Emphasis, slightly softer on the revenue front. So it's a constant currency revenue growth of 1.8%, which is lower than what many of the mid-cap peers are reporting. That said, margins at 15.3% are flat on a sequential basis and in line with street expectations. Happiest Minds has had a fairly steady quarter, a dollar revenue growth of 5%, margins also maintained sequentially at 25.5%, and a profit jump of about 5.5%. So broadly steady, but only in the case of Emphasis, the revenue growth has been slightly lower than street expectations and also lower than what peers are reporting. So that's the reason I'm going with red for Emphasis. Back to you.
Rima, thank you very much for that. Dixon is the other one which reported earnings. Vahishta is here with a report. Vahishta.
Hi, Prashant. Thanks for that. Dixon Technologies' performance has more or less been in line with the estimates. The revenues were up 38%. The margins have come in slightly lower at 3.8% versus 3.9% in the same quarter of last year. Now, in terms of segmental performances, mobile and EMS division has been the best performing segment in this quarter, with revenues more than doubled to 1,600 crores. And this division now contributes 41% of the total revenues versus 21% in the same quarter of last year. Home appliances has been the second best performing division, with revenues up 62%. Lighting products revenues were up 27%. Security systems revenues were up 19%, and consumer electronics revenues came in more or less flat at approximately 1,500 crores, and its contribution to total revenues has contracted to 39% versus 53% in the same quarter of last year. The management has guided for FY23, when the revenues are expected at 15,000 crores. The margin guidance has been lowered to 3.8% to 4% versus 4.1% earlier, and this is due to the lower unit realizations in the LED TV business. In terms of brokerages, Credit Suisse has an outperform rating on the stock with a target price of 4,500.
Okay, that's important. Dixon Technologies lowering their margin guidance may not be taken too well by the street. But let's go across to Vivek. He's tracking IEX. Vivek, how did the numbers look?
Well, it's a slightly muted quarter as far as IEX is concerned, largely along expected lines. So when you're talking about IEX, the revenues actually were down around 13.5%. The EBITDA too degrew around 17%, and the margins on the back of that actually saw a contraction of a little over 300 basis points. When you're talking about the profitability, fell down 8%. If you're looking at the key reasons for this particular degrowth, number one, the price capping on the exchanges was something that impacted the volumes as sellers stayed away. You're also talking about the actual volume figure falling down almost 10% on a year-on-year basis. Going forward, this is what analysts say as far as the Q3 is concerned. Number one, the approval of the long duration contracts for IEX is something that's going to be an important trigger. They estimate, a significant opportunity of close to 74 billion units in that particular segment itself. And despite the entry of some other exchanges in this particular segment itself, IEX has managed to maintain a market share of 90%. So that is some positive to take away as far as these results are concerned.
Okay, to our entire team, thanks a lot for joining in and helping us prep for the day. In case you missed out on any of the stocks, here's a quick recap of our top 10 stocks that we're watching. Stocks with positive news flow. There's, of course, Axis Bank and ITC that tops the charts. Bajaj Finance, Tata Consumer Products, Sriram Transport, Happiest Minds and Dixon Technology. While stocks with negative news flow this morning, United Breweries, Emphasis, as well as IEX.
Welcome back. SGX is suggesting a flattish or mildly positive start, but Sonia earlier on the show told us that she cannot go off for shopping post-market because she'll be tracking Reliance's numbers. So I don't know about the shopping, Sonia, but you tell us about what to expect from them.
So, this time around, Reliance is going to come out with earnings in the evening, and the expectations are not that great because there has been weakness in the oil to chemicals business. So that's going to drag down the overall numbers for Reliance. The three key expectations are, one, there's a sharp decline in the oil to chemicals business. There's also a big decline that we've seen if you split it up in both the refining margins as well as in weakness in the petchem business. So that will cause a double-digit fall in the EBITDA on a quarter-on-quarter basis. But on the flip side, the consumer-facing businesses, both retail and Jio, have done well. And there is an expectation that for Jio, the revenue growth will be in excess of 20% year-on-year for the third consecutive quarter. So that's positive there. ARPUs will also increase for Jio. Now, here are the consolidated numbers that you can watch out for. As I said, on the revenue front, it could be a single-digit growth, about a 5% growth. The real problem for Reliance will come through in the EBITDA performance. EBITDA is expected to fall by 14% compared to last quarter, primarily due to weakness in the oil to chemicals business. The margins will also fall from 17.5% last quarter to 14% this time, and that will cause a drain on the profitability. But I guess a lot of this is factored into the stock as well. If you look at it, Reliance is down 13% from the highs that we saw in April to the tune of 2,819 rupees. So let's see. But for now, the numbers that they'll report today will indicate weakness for sure.
All right. We've got Harindra Kumar now joining us, Managing Director at Ilara Securities. Harindra, I mean, you set it up for us. You heard Sonia explain what to expect. But to your mind, what's the big one here?
Yeah, you know, I think Reliance is not a quarter-on-quarter story. What the market is always now trying to play is, now that the first leg of the strategy in terms of the digital play has played out, the next leg in terms of ARPU expansion, the demerger, and how the value unlocking plays is what is in the minds of investors. I think the market has, preempted our ARPU increase on the 5G side with respect to Bharti Airtel and Reliance, but I think it's some time away. So all these earnings triggers, so we can say strategy 2.0 will start playing up somewhere closer to June next year. So it's a H2 story for FY 23-24. And the sharp price rise in the stock in recognition of what is going to flow will only play up in the next calendar year or for the second half of the fiscal year. So my guess is it's not a quarter-on-quarter earnings story that needs to be watched. One is you have to see the 5G how it is progressing in terms of customer adds, in terms of ARPU expansion, then more news bites on the demerger, and obviously, on the new hydrogen energy space of how quickly they are going to backward integrate in their oil to chemical business. So these are large strategic initiatives. There is deep value in the company, not a quarter-on-quarter story.
Okay, all right. Hi, Harindra, morning. I wanted to ask you about ITC. That one out of nowhere, when everyone had shunned it away, maybe last Diwali as well, suddenly it's got its act together and the numbers look splendid, whether it's their core business, whether it's the smaller parts of their business. What would you do with the stock? Now we're at around 350 rupees.
Correct. So I think there is still some value in the stock. In fact, it is the best performing FMCG stock, and it is what is actually helping the FMCG index staying afloat. If you look at some rest of the players, even with respect to HUL and Nestle, Tata Consumer, United Breweries, whatever you're seeing is pressure on margin, pressure on top line. It is in fact ITC which is doing well. So three variables that worked in favor of ITC and continue to work in favor of ITC. Number one is it was a value stock when actually this rally began. So value, quote unquote, is the theme globally over the markets, and ITC, after the deep underperformance at 200 rupees, started his journey from there. The yield was very good. And second is then the GST taxation overhang kind of lifted with, there's no further communication from the government on that front. And at a much larger level, I think the bigger question is now whether the investors are looking at ESG as a theme to play. And given all the concerns on energy globally now, I think the way the investors are looking at ESG plays now has got moderated. So this overhang on ITC also has come off. So these tailwinds exist in the stock. The numbers seem to be supporting it, and most businesses seem to be fighting. So yes, on the FMCG side at the moment, we have ITC and Britannia and Nestle, which are the three picks vis-a-vis rest of the other ones that are there. So if you're playing at a tactical intra-sector theme, these are the three stocks that will stand out.
Okay, I guess smokers got to smoke, right? No one's going to stop smoking just because it's bad for health, perhaps. Wanted to talk a little more about Axis Bank, Harindra, because yes, the numbers are very strong. Yes, it's like multi-quarter high in terms of loan growth, etc. But the stock has also had a smooth run, right? I mean, it's gone from 600 now at 800 plus. You think a lot of the good news is in the price, or would you take a fresh position here?
Yeah, so I think prima facie, if the market has to go to 20,000, it has to be the bank nifty. And the numbers are very, very encouraging for all the players. So I think the market will negotiate this quarter, take a fresh assessment, and probably try to take a lift off from these numbers. And within that, which are the names that are probably going to be the outliers? So if ICICI Bank is over-owned, if you look at all the nifty positions of all fund managers and globally, so it on the total weight that they are allowed, they are significantly overweight. So the next in line now is whether you want to trade HDFC Bank or Axis Bank. I think the bets that the market is taking till now is that till the indices reallocation, realignment doesn't happen, you need to go with the second private player, which is now Axis Bank. So numbers have supported. So I think it will move now in tandem or do some catch up with ICICI Bank. So huge valuation comfort still because it's around 2 times price to book multiple. So in our view, Axis Bank will continue to trade higher. Now, one more point I would like to add here is that within that, the PSU Bank Index is looking to outperform the private bank index. So that is where your alpha trade setup is, which is in the bank nifty. And if your allocations are right, you could end up outperforming the nifty in a significant way.
Okay, well, stay on. That's on the banking space, but we're also going to discuss the IT space. Mastech is the first corporate on our radar right now. The company has clocked in a dollar revenue growth of 6.1% after the 4.6% decline that we saw last quarter. And the margins have contracted 200 basis points this time around. Also, the company has a large exposure to Europe, to UK as well. And that seems to be the problem pocket, as we all know. Hiral Chandrana, the global CEO at Mastech, joins us now to talk about that. Mr. Chandrana, good morning and happy Diwali to you and your entire team at Mastech. It has been a challenging quarter, primarily because you have a large exposure to UK and Europe. Just wanted to understand, how is the situation over there? Europe declined about 2% quarter on quarter. What kind of growth are you expecting going forward for the rest of the fiscal in constant currency terms?
Thanks, Sonia, for having me, and wishing all of you a happy Diwali and best wishes for the festive season as well. So let's start with the overall performance. We're actually progressing well with our strategic priorities. Our year-on-year growth on constant currency was 20.4%. As you mentioned, our UK business is our largest business. And while there is geopolitical uncertainty, we've actually signed up some very large framework deals. These are more medium to longer term deals, but are very, very strategic. Where we are among a top few suppliers, whether it's the technology services framework or the data and analytics frameworks. So our team out there is doing a fantastic job, very resilient. We obviously have a currency impact, as you know, because of the sterling pound versus USD. But in spite of that, our continued focus on very critical national infrastructure, right, whether it's borders and immigration, whether it is trade, whether it is defense and security, we're doing a fantastic job. Our US business has definitely been boosted with the recently concluded acquisition as well. So now we have Salesforce as another ecosystem in addition to our Oracle Cloud business, which gives us a much more end-to-end transformation capabilities.
Got it. Hiral, sorry, we'll come to the US because that's a smaller part of the business. Just to stick with UK for a bit longer, could you tell us UK government contributes to what percentage of your work out of the UK? Because that is where most of the flux is, right? I mean, over the last so many weeks now. So we'll probably get a new government, a new head of state. There's a severe crunch on fiscal resources, spending. So I'm assuming that everything will be given a relook. So I just want to understand, what is the exposure to the UK state, the UK government? Go on.
Yeah, so Prashant, I think it's important to understand where we are playing in the UK government. This has been a business that we're there for the last 20 plus years, as you know. And when it comes to certain critical areas, right, whether it's defense, security, borders, trade, immigration, we manage about 5 million passport intake applications a year. We do about 25,000 irregular immigration cases. So I think the key elements, while there is a lot of uncertainty at the macro level, and completely understand the geopolitical issues, but as far as the civil servants, the people who we work with, some of this critical infrastructure we actually see a lot of stability and continued growth. In fact, from a medium-term perspective, we see that there's a lot more opportunity in the UK public sector, in spite of some of the macro-level headwinds that the country is going through. Having said that, clearly we're keeping a close watch, and we'll continue to tweak and make some changes to the strategy, which also brings to the point where we want to do some diversification, right, from a regional perspective. But our UK public sector business, back to your question, right, that's about 60% overall is our UK business. And within that, roughly about 50% of that, or 55, 60% of that is the public sector.
Okay, got that. Hi, Mr. Chandrana. I wanted to ask you on two parameters. One is the attrition. It's, come down for the second quarter consecutively, which is good news. Do you see further softening from here? Point number one. Point number two, on your margins. At the first half of this year, it's at around 18% odd. For last year, you did around 21%. So it's seen some bit of cooling off. What should be the steady state margins we should work with?
Sure, Nigel. We've been actually very transparent that we are comfortable with the high teens. Obviously, high teens is the range of 17 to 19%. We don't guide for margins. Having said that, our attrition, like you pointed out, actually has trended down third quarter in a row, which is good news. But again, we are continuously focused on our people, retention, our skill transformation. Talent costs, as you know, has gone up, so that has clearly impacted margins for the industry. But we believe that this is the comfortable range when it comes to operating EBITDA. Attrition, it's a tough one, but I definitely see a lot more stabilization and cooling down given the macro level uncertainties as well. And we're doing a lot of people-focused initiatives in Mastek.
Okay, well, we hope that the challenges, you can wade through the challenges, because it's been a tough year for not just you, but your shareholders as well. I mean, the stock is down 40% in the last 12 months alone. And of course, you do have a presence in some challenging pockets like UK. So all the best for the quarters to come, and happy Diwali to you once again. Well, that's the word coming in.
Welcome back. Well, let's get in our technical experts. We have Mitesh Thakkar as well as Shrikant Chavan who join in. Morning, gentlemen. Thanks so much for joining in. Well, Mitesh, you go first. Tell us, what's your call on the Nifty?
Morning, Nigel. My understanding is that we are positively biased and looking at targets of around 17,750 to about 17,800. And I think any, mild gap down in the opening would be a good buying opportunity, keeping yesterday's lowest stop loss.
And what about you? Mitesh is sounding reasonably optimistic about 17,750 to 17,800. Are you in that camp?
Yeah, good morning, Nigel. Good morning, everyone. And happy Diwali and entire festive season to all of you. I think, yeah, definitely the markets are doing really well. Yesterday also, when the market was down, it was very close to the crucial important support levels. But from there, all the way it bounced back and it closed above the mark of 17,500. So broadly, we are also expecting market to move towards the levels of 17,700 to 750. And today, specifically, if it see the market is crossing the levels of 17,610, then there we should look for adding some long positions. We can expect immediately on short-term basis 17,700, and for the bank Nifty, we are expecting 40,600, 40,700.
All right, we have to take a short commercial break, but don't go anywhere. When we come back, we'll get a lot of ideas from our experts, and we will also have one of the managements with us, Atul Lal, the MD at Dixon Technology, will be with us to discuss their Q2 earnings performance. Stay tuned.